Hello, everybody. My name is Martina Bozadzhieva, and I'm Chief Research Officer here at FrontierView. On behalf of my colleagues, we welcome you and thank you for joining this episode of GlobalView. Always very interesting and always a lot to talk about, but I think today is a special session for us. I'm joined, as always, by my colleague Elizabeth Rust, who runs our global economics team. And we will be talking in a few minutes about some of the biggest global macro issues the multinational clients are really grappling with. So lots for us to cover. It's been quite an eventful couple of weeks in the global economy. Elizabeth, get us started. There's probably more on the agenda than we can handle in this amount of time.
Yeah, honestly, a lot of things we could cover, but as usual, we've kind of drilled it down into 3 topics, and they're all interrelated a bit. Sort of one issue flows into the next, as usual, when we're kind of looking at the global picture. So the first, we'll talk a bit about Fed policy. There's just been a lot happening there in the last couple of weeks, quite a bit of surprise. That's led to quite a bit of reaction in financial markets. So we'll spend a couple minutes just recapping what happened there and drilling down into it a little bit. I thought we'd then talk about how the change in Fed policy, along with a couple of other changes, has affected our US outlook. And spoiler alert, it has brought about a major downgrade to our US forecasts for the next 18 months or so. And those 2 first topics start to beg the question of topic number 3, whether we're headed for a global recession. And you're hearing people ask that question more and more. So we'll try to engage with that for a minute.
Okay. Yeah, let's start with the Fed. A bit of a surprise move, although I think there were concerns that this may take place. Help us understand the logic behind it also, because a lot of the inflationary issues are really driven by factors that it's unclear that the Fed can really control on the supply side. How do we think about its policy priorities now, and what does that mean for future Fed hikes?
Yeah, so as I kind of indicated in the title of this, that there's been a big shift in Fed policy in the last couple of weeks. It started, as always, it has to do with the US inflation outlook. So actually, just to kind of illustrate the timeline a little bit of what happened, on Friday, June 10th, we got a release from the US Bureau of Labor Statistics on the CPI inflation reading for May. And it showed that year-on-year inflation in May was reached 8.6% headline inflation, a new 40-year high. The last several months, the US inflation has continued to hit new 40-year highs, and it hit yet another one. It wasn't a total surprise. As you indicate, there were obviously concerns that US inflation would accelerate, especially due to Ukraine war spillovers and the impacts on energy prices and commodity markets. But it was a little bit of a surprise, especially because inflation had eased a bit the previous months, and that had started to bring about hopes that we would see potentially a bit more easing or stabilization over the course of the summer. It also was a bit of a surprise because you have been seeing some stabilization and easing in core inflation, which normally the Fed would be quite responsive to, but that headline inflation reading was a lot higher than expectation. So you saw immediate market reaction, tumbling equities, rise in bond yields. You saw 30-year fixed rate mortgages in the US touch above 6% for the first time in decades. And so in effect, the market started pricing in the expectation that the Fed was going to hike faster as a result, that the Fed would hike with 75 basis points at its next FOMC meeting instead of previously expected 50 basis points. And that is indeed what the Fed did. On June 15th, the Fed announced a 75 basis point hike, the biggest hike in nearly 30 years. And that went together with continued acceleration in quantitative tightening as well. So you're getting tightening monetary policy in multiple directions. This is obviously the 75 basis point hike was factored in to some extent, and we had anticipated it as a possibility in our Fed scenarios, which we've been talking about for a few weeks. But what was a shift was the Fed kind of communicating implicitly, if not explicitly, that it is now singularly focused on inflation alone, that high inflation is its #1 concern, and that it is prepared to keep hiking to pull in inflation regardless of what happens to the US economy. So even if unemployment rises or even if it causes a recession, that it will hike aggressively regardless. And so since then, markets have begun pricing in a very high probability of another 75 basis point hike at the next meeting in July. You asked the question of whether this will help bring US inflation down. Obviously, it's been a bit of a debate whether tightening monetary policy helps when we're dealing with inflation that is partly supply chain driven and commodity price driven. Our view is that it may help in the short term simply by weakening demand, so essentially by causing a recession. But it's not necessarily, I think we're seeing narrowing scope at this hiking pace for the Fed to engineer a soft landing, which is what it's been trying to do, or at least was initially trying to do.
Elizabeth, can I pull out one implication here? So obviously with the Fed hiking rates, that's having an impact on global financial markets, and ultimately is going to force other countries to also hike interest rates, possibly faster than they originally intended to. Looking at some of the data recently, there is a shocking number of countries with negative interest rates right now. And that is not a sustainable situation when you have this level of tightening in the US. Is it fair to assume that we'll be seeing more hikes, maybe more aggressive hikes by central banks around the world, both developed markets and emerging markets, as a result of some of this change in Fed sentiment?
As a rule, yes. It's sort of unsustainable with the pace that the Fed is hiking at. If other countries are not roughly keeping pace, they will suffer the consequences of primarily depreciating currencies, in various implications in terms of their debt dynamics. But it's a number of countries walk a tightrope because they may not be fully recovered from the economic impacts of the pandemic. And they know they in many cases may already be in the midst of an economic slowdown, and they know that faster tightening is simply going to worsen the economic outlook even further. To draw one example, the ECB is in quite a bit of a bind because it knows if it hikes fast enough to keep pace with Fed policy, it's going to contribute to widening bond spreads between Northern and Southern Europe and potentially start another Eurozone crisis. So that's kind of the tightrope that the ECB is walking in this environment. But overall, as a general rule, we're talking about tightening global monetary conditions. Just to kind of take a step back and think about how this relates to how we've been thinking about the global outlook a little bit. We're actually going to obviously talk about that at the end when we ask whether we're in a global recession, but we have, as a big part of our global outlook, one of the key questions we've been monitoring is Fed policy, obviously, for the reason you identify in part that faster Fed hikes force other countries to raise their benchmark interest rates as well, with knock-on effect growth implications for those markets. So we identified several weeks ago what we first saw as three main scenarios for Fed policy. And our prior base case was still a pretty rapid tightening path that would bring the federal funds rate upper bound to 2.75% by the end of the year. But we did also foresee the possibility that the Fed would escalate. For us, we imagined it to be a minority possibility because we considered that the Fed was not only targeting inflation, it was also trying to engineer a soft landing and prevent a recession in the US economy. And now with this change in Fed policy and the shift, we've moved basically into our escalation scenario. And you can see that in this chart where the red line was the scenario we were advancing. And then that dotted line is now where market expectations sit based on what the Fed has communicated about its plans. And they pretty well line up at this point, which is a signal that we are, if not fully into that scenario, because things could potentially change in the next couple of months, if there's another kind of surprise in the US inflation reports that shows inflation coming down, but we don't think that to be likely at this point.
Got it. And so I guess that takes us into the conversation about the US economy and its outlook. How do you see that evolving over the next few months? Is a recession likely?
Yes, so the shift in Fed policy and obviously the shock inflation reading that prompted it, the combination of those two things has forced a major rethink about the US outlook, where we previously saw it as a reasonably resilient market despite all these global headwinds, in part because it's quite insulated from war spillovers. It has a strong base of pent-up consumer savings to support consumer spending. But notwithstanding those advantages, we are seeing inflation accelerate, and now the Fed is hiking faster, and that's a big headwind to growth. And now the other big change that we've seen in the last couple of weeks is a spate of bad US economic data. So probably the most prominent was the retail sales report for May that came out a few days ago and saw nominal retail sales actually fell a bit in May. And the few areas that did rise were things like food and beverage stores, gasoline stores, which point to mainly high and rising food and energy costs, not necessarily a kind of underlying strength in discretionary consumer spending. So you're starting to see weakness in the consumer spending outlook. You're definitely seeing weakness in the housing outlook. We're seeing weakness increasingly in manufacturing as well. So it's coming from all directions and suggests that the US really is in the midst of a slowdown and is likely to see a recession later this year. So that's actually our call, that the US will enter a recession in Q4 of this year that will last a couple quarters. And that actually reflects in our new annual growth forecast. So here you can see US real GDP growth going back a few years. And our previous US real GDP growth forecast was 2.4% for this year, and we've already downgraded that to 1.8%. And unfortunately, a lot of that growth has already happened since we're about to enter a slowdown, and we'll see even negative quarter-on-quarter growth by Q4. And given that the recession is expected to extend a bit into next year, that also really weakens the growth figure for next year. It won't necessarily be negative, but if we do get a couple of negative quarters of growth, that translates to a very weak figure for next year, and that's also a big downgrade from 2.2%. So this is obviously a big downgrade for our US growth outlook, but it's one that looks increasingly likely at this point.
So we have a much tighter monetary policy at the global level. We have US possibly in recession. We're not going into this topic in detail today, but we're obviously having issues with gas supply into Europe, and no real improvement in the situation in China. So is that enough to tip us over into a global recession scenario? I know we've been having arguments about this, but
yeah, this is actually probably the big fundamental question that we're grappling with on our research team at FrontierView at the moment. And to kind of set this up, let's go back actually to the Global Scenarios report that we published about a month ago now, where the general kind of premise of the report was that the global economy is in an environment of great uncertainty. There are quite a few things we knew and know to be the case, that China's growth is slowing down, that there is a war in Ukraine and it's likely to last for a long time with various spillovers and implications, that inflation is high and it doesn't look like it's easily coming down anytime soon. Go on down the list, a number of things we are reasonably confident about, but that there are three key areas of uncertainty. Big one is around China's zero COVID strategy. We've talked about this quite a bit on previous episodes of GlobalView. Europe's energy supply has also been a big topic for us, as well as Fed policy. And that in turn drives a number of secondary impacts. And kind of how those three drivers of uncertainty play out is what built the framework around our global scenarios. So whether the global economy will be in an environment of stagflation, whether we might see a bit of a reprieve and slightly higher growth in our base case, or whether we could even tip into an outright global recession. Now, you see in here that Fed policy is in the list of 3 key drivers of uncertainty. And when we published the report, we considered it most likely that Fed policy would proceed according to our base case. So reasonably aggressive tightening, but not any faster than what the Fed had already communicated. Now, of course, we've seen a big shift there, and essentially we've moved into our downside scenario for Fed policy, the downside being escalation. So now that we're in that escalation scenario, and just this is kind of how the various drivers of uncertainty play out in terms of the upside base case and downside, a matrix kind of representing this on a high level. That basically takes away our higher growth scenarios out of the question. That it's very difficult to see at this point that the global economy somehow gets out of this slump it's mired in and sees an acceleration in growth at all in the next 18 months. So we're left basically with global stagflation or global recession, and it's essentially a coin flip 50-50 or so, which one of those we fall into. There could be some reprieves that would keep us in the global stagflation scenario at least. You could see the Fed back off a little bit. Again, we don't think that's likely at this point, but it could happen. We could see potentially an upside with China's zero COVID strategy. Maybe China finds a way to exit earlier than we expect. Again, we think it's not super likely. Or we could see a reprieve in another area that we haven't considered. But overall, the scenarios that we advanced are the correct ones in terms of how things have turned out in the last couple of weeks. And with Fed policy, unfortunately, we've moved into our downside scenario, which has significantly raised the risks of a global recession.
Understood, but also quite concerning, I have to say. I think as we go into some of the planning season that I know a lot of multinationals we work with are going through right now, both reviewing plans for this year to confirm whether the assumptions there still make sense, and also doing early views on 2023. I think this sort of work is really helpful in setting expectations right and making sure that companies are taking steps that are appropriate to the context in which their businesses are operating right now. I know from a lot of these leadership sessions that we're having with clients that there's a lot of uncertainty and the need for real alignment within teams on what are we comfortable assuming into our plan, because it starts to come with pretty significant implications from we have to streamline our product portfolio considering the inflationary environment and potential trading down, to which are the customers that we think are most resilient, what kind of price increases can we really do, how do we reset supply chains to see if we can address something on the input cost side, and ultimately what does that mean for budgets for next year, which is a scary topic that unfortunately is coming back to the fore when you're in potentially a recessionary environment in some of your major global markets. Looking at the cost side of the equation really starts to become important. So as with a lot of our clients, we're here to support, happy to support some of these leadership team discussions, as well as to provide inputs in the form of data, narratives, analysis, and scenarios. And I'm sure we'll be coming back to this topic next month. Hopefully some good news between now and then, as opposed to all bad news. But this is the reality in which we live, and we need to find ways for companies really to win, regardless of this context.
Absolutely.
Wonderful. Well, with that, thank you everybody for joining us in our GlobalView conversation today. Please reach out to us if you'd like to hear more, and looking forward to our next session in a month.